financial information provided is not to be used for investing purposes. If you do wish to use any of the news or information provided, please seek a certified financial advisor or certified financial professional. John Galt, the host, johngaltfla.com, nor thewatchman.biz cannot be held responsible for investing decisions the individual or listener makes using the free information provided.
Welcome all to the Sunday Night DeathBurger program with John Galt. You've heard the disclaimers, you've heard the news, and let's get right into it. The Dow Jones Industrial Average had a very nice week this week, as you can see, and then hit a brick wall. The brick wall it hit on Friday after a nice recovery day is best illustrated by this chart, which shows that resistance may not be futile. It hit a level near 13,000. It couldn't peak it. It could be brutally ugly. It's a longer-term trend chart breaking back down to the 2008 level. If you look at the 3-year chart, there's a major resistance area from about 12,900 to 13,500. It doesn't look like it's going to break it. And in fact, what has happened is it's failed to pierce the old resistance levels, and it looks like a chart that's getting ready to roll over and come back downtown, and we're going to get back to those 6,500 levels. Evidence of this is the insanity we saw in the Dow bullish indicators, the Dow bullish percentage. As you can see from this chart, we were nearly 100% bullish for a long period of time. We've finally seen some correction with all the turmoil in the Middle East. The transports are another indicator. It didn't top its 3-year ago high. Right before the crash in 08-09, it looked great. Same thing with energy prices. We're repeating a similar pattern today. We could come down hard and fast, and I do believe we'll get down into the 2,400, 2,500 price level on the transports pretty quickly. S&P 500 is tracing out an almost similar, if not identical pattern. If you look at the right-hand side of your chart, you see the breakdown that occurred last week, and you see the encircled area there, which indicates that we could be at a topping level. If this topping action persists for another couple of weeks and then we roll over, it'll be hard. If it suddenly bounces back and pierces it with volume, which it has not been doing on the upside, only on the downside, it could make a difference. But if you look at the 3-year chart, just like you did with the Dow, there's a major resistance level, and the S&P didn't even come close to testing 1,400. Not a very positive indicator. I think we're going to come back down to about 1,000, maybe 1010, give that another run, and if that fails, this means the indication that we are heading right back down to S&P 600, 650. The Russell 2000, almost identical chart pattern, a little bit healthier than the Dow and the S&P and the NASDAQ. We want to talk about the NASDAQ today. Just keep an eye on what happens. I think that these guys are ready to roll over faster. The big boys in the Goldman Sachs, great example of what's going on with the S&P and the Dow. As you can see, it got up to major resistance last year, failed. Didn't make it this year, didn't even come close so far. In 2010, didn't come close so far this year. Primed to roll over and retest the 130, 132, 135 level. JP Morgan did a little bit better, but over the 3-year period, once again, did not get into that red sector that I've highlighted on the chart, has not been able to break that resistance level and achieve new highs. I think it's primed for a rollover. Let's get to some of the dogs in the big financials. The Bank of America couldn't even get close to where it was 3 years ago, not even to the halfway point. Has hit a resistance level around, I'd say 19, can't pierce it. Has more problems than you can say grace over. Notice I didn't put moving averages on here. I don't think it's relevant with this particular company. We could see a massive rollover in this chart and a new low achieved before it's all said and done. From the GSE perspective, Citigroup is in worse shape than Bank of America. It has sat there and failed to get even close to the levels despite massive infusions of government taxpayer assistance. It's not come close to touching the resistance level over the last 3 years. The chart is extremely unhealthy. The stock price is only supported because the Federal Reserve is intervening as much as possible. This will not end well and will become rather bloody and ugly, just like another big boy that no one's talking about that's having issues of its own. The technical formation on Morgan Stanley is brutal. You see the breakdown in 2008, 2009, and then you see the faux recovery, but what you don't see is any sustained strength getting it back above that resistance level and even coming close to achieving a new high like the rest of the market. So you have to start asking yourself what's causing these problems. This isn't going to end well for these stocks. They're telling you that the market is fundamentally broken and technically broken. Why? Overseas today, you see the headline from the ArabNews.com. It's a Saudi Arabian national organ. Region's bourses lost $140 billion in 5 weeks. It's a conservative number because a lot of those markets just shut down. Bahrain and Egypt, etc. No one wants to talk about what is going on in the Middle East. They're trying to ignore it like it's under control, it's going to go away. This particular indicator is going to rotate around the world again as we have more protests and days of rage scheduled in the days ahead. It will cause more issues. And your major indicator came tonight in the silver market, which broke the $36 level. When I took this snapshot, it was at $36.12. It's gotten as high as $36.33. Silver is telling you the rally is on. And it's a very simple process for watching this. If you look at this chart, and this is from finviz.com, a 5-minute tick chart, you see how suddenly it shifted higher with the Asian market open. When you look at the longer term charts, well, you know what we'll do is we'll take the ETFs, the exchange traded funds, the SLV. Let's take a line, just like Dennis Gartman likes to say, go from the lower left hand corner to the upper right hand corner. As you can see, it's going up. You have both moving averages in the correct direction. You see a lot of dancing above the 50-day moving average. You don't see a lot of dancing below the 50-day moving average. In fact, you haven't seen a retest of the 200-day moving average since last September in silver, last August, excuse me, when everyone thought the world was going to come to an end, and the Federal Reserve guaranteed more liquidity and threatened to do other actions, and not just QE2, by the way, which sat there and caused this entire inflationary market move. When you look at the 3-year chart of SLV, you see the golden cross right after the 09 high where the Fed were here to inflate and kill your economy and your dollar to help you notice. And since that time, that golden cross has held as one of the longest held technical formations I've seen in my lifetime. I've not seen a chart go 2.5 years after a golden cross with a positive market movement. Unfortunately, it could be an indication of a parabolic blow-off coming up, but the reality is it's a cha-ching. You take advantage of it, you make money, and you don't fight the trend. The pattern is perfect, lower left to upper right, and the volume in the last couple of months is supporting this. This is what's different from gold and other precious metals. If you look at the volume on the right hand side of your chart, which I've circled, and the upward momentum after the golden cross, you notice that we've hit higher highs with higher volume on the SLV. If you look at the individual contracts at the various trading markets around the world, you notice that volume is also extremely high. Also, volume for delivery is extremely high, and there are a lot of shortages in the physical metals starting to appear in the coin market and with smaller dealers and distributors. Gold is a different story. Here's a 1-year chart of the GLD. Lower left-hand corner to the upper right-hand corner. Not rocket science again. Both moving averages are nice. We haven't seen a test of the 200-day moving average in over a year. The 50-day moving average has been holding nicely, although this consolidation recently could break either way. On the 3-year chart, you see the golden cross again, right there at the start of 2009. Another extremely long-term golden cross formation. It's the big cha-ching. What I cannot believe is that it's lasted this long. This is despite massive central bank intervention and market manipulation. The other central banks, especially in Asia and East Asia, are demanding delivery of their metals, and they want that metal now. They don't want to wait. They want it now. Unfortunately, the GLD is a bit tricky. You can't really tell by the contracts being traded, but what you can see is that the volume has been depreciating or declining in the last year. And I'm not sure if that's a positive sign for the markets or not. The ETFs are a little bit like the holding companies of the 1920s and 30s, in my opinion, where they simply are representations of paper investments and not really substantiated by the backing that they claim they have. We'll find out as the short squeeze occurs and delivery demands increase. the next 6 months will be the most interesting in our modern lifetimes. The dollar is another telltale sign of what's going on. If you look at this chart of the power shares bullish over 1 year, you notice that since last June, when we had the blow up in our markets after the flash crash and that huge volume day on the dollar, all hell's been breaking loose. People are getting rid of their dollars and phasing out of the positions. You have a really very, very nasty death cross right there in the middle of your chart. It was last September, October, and it is not looking like it's about to recover anytime soon. In fact, both the 250-day moving average, it's been trading below that for the majority of this year. Traded for it extensively from September through November. The dollar is just absolutely falling apart. Not a positive sign from the perspective of the American future for inflation. I would say we're going to see massive inflation as a consequence of this. On the flip side, the UD and the bearish dollar ETF, you see a golden cross there. That golden cross is circled on your chart. In this 1 year chart, you see the huge movement in this particular ETF to the upside, trading nicely above the 50 and 200-day moving average. It's based out quite nicely in this particular price range, and it should break higher, getting above the $28 price target before too long. Once it's above $28, all bets are off. You see the resistance level that it has to encounter, though. It has to get up above 30, I'd say 30.50 to make a new high and to hold it. So we'll see what happens there. I'm not 100% positive that will happen. The Fed will have to decide whether or not to intervene at some point. As it sits now, I'm not going to hold my breath on anything good happening from this. I'll put it to you that way. Last but not least, it's time to do a review of the old 136, the 1, 3, and 6 month Treasury. As you can see in this chart, from November 2006 to last week, the 1, the 3, and the 6 month Treasury bill, which is what I called Beck about a long time ago and warned him what was going on, is still hovering barely above zero. They're using a de facto carry trade for the Treasury to fund this government. It's not going to work. It's going to blow up in their face someday. People are not going to want to sit there and subsidize the United States government for no return. The majority of the shareholders in this are overseas banksters, the central banksters. They want to get out of the long term and into the short term, so when the music stops, they're not stuck holding a 30-year note that they'll never be able to collect on and is worth absolutely zero. If this was a true economic and market recovery, these yields would be trading substantially higher, as you can see from a historical chart of the 3-month T-bill. This is a very good perspective. Whenever you see strong recoveries dating back to 1954, the yields spike. They get up above 2.5%. Why? Because you don't want to buy a 3-month T-bill yielding 2, 3% when you can have equities that yield 5, 7, and 9%. Well, now we're juicing the equities and investments to make this thing work. This isn't going to end well. There's going to be a trail of tears when this is all said and done. We're breaking all the historical patterns and taking the free market out of the economy and out of trading our debt. Look out below. This has been a production of JohnGaltFLA.com. If you go to my blog at JohnGaltFLA.com, you can keep up with what is happening with the radio show, with my writings, with my updates. I do everything I can to update on a daily basis. I am broadcasting on the Watchman.fm Monday through Friday from 7 to 9 p.m. Eastern Time. Archives are available, and they are linked at JohnGaltFLA.com and also at thewatchman.fm. Tune in for all the great hosts and more, and if I have a special broadcast or special video coming up, you'll be notified at my blog. Don't miss it there. Remember, folks, when trading, please make sure you get a certified financial professional or know what the hell you're doing. Don't take my advice for this stuff. Don't take my technical analysis to the bank. I mean, you could, but I'm warning you now. Do your own homework. Verify the facts. If you like what you see, make it work for yourselves. But don't trust the government. Don't trust the statistics that they're spewing out. And believe me, after looking at the unemployment report last Friday, it's not as great as it seems. This is John Galt speaking. I'll see you tomorrow night on the air, 7 p.m. Eastern, only on the Watchman.fm.